Today's topic is going to be looking at the financial system. As I mentioned in the first class, the financial system, everything can be described with what we're looking at on the board right now. We are dealing with those who have money, surplus spending units. I will usually abbreviate these SSU, surplus spending units. And those who need money, deficit spending units. I'll usually abbreviate these DSU. This is our view from outer space. If we're looking down, we see money going from surplus spending units to deficit spending units. And it's worth taking a second here to think about how this is slightly different than you learn in many economics classes. In economics classes, we often call these households, and we also often call these corporations. While that is true, on net, corporations need money and households are the providers of that money. I want to be careful and not use that, because at any given point in time, any organization or individual can be on either side of this. A typical college student is a deficit spending unit. They are borrowing money from people who have it. They are borrowing it. At some point, they have to pay it back. The student gets a job, goes out in the field, they become savers. They have money, more money than they need. They invest, and it goes to those who need it. So be careful with the distinction here. Don't just use households and corporations, but let's think of it, those who have extra money right now and those who need extra money right now. As we zoom in closer and closer. We go from the far out satellite view to a closer view. Other things start to appear here. We start to see what I will call financial intermediaries. Financial intermediaries. Financial intermediaries include such things as banks, stock markets, investment bankers, mutual funds, etc. Insurance companies, a whole list of financial institutions here. What these do, and their only reason for existing, is to lower transaction costs through the system. For instance, imagine the difficulty if you needed to borrow and you didn't have a bank to go to. Or imagine the difficulty if you had excess money and you didn't have a stock market or a bank to invest in. What they do is they're go-betweens. They lower transaction costs, and that's important. Remember, the role of a financial intermediary is to reduce transaction costs. Sure, they get paid for doing it, and some of them get paid very well for doing it, but their overall goal, reason for existing, is to reduce financial transaction costs. When we look at this even closer, we see that firms or organizations, deficit spending units who borrow money have to pay it back at some point. The money that gets paid back goes here. Some of the money gets reinvested. They take profits, they reinvest back at the firm. Money flows back to the investors via dividends, stock buybacks, and interest payments. Money goes to firms' deficit spending units in the form of stocks and bonds. They sell a piece, or loans in general. They sell a piece of paper, essentially an IOU, saying, I will pay you at some future point in time if you give me money. Oftentimes, this really is everything we need to do in finance. Everything we look up for the rest of however many finance classes you take is on the board right now. Again, as we zoom in closer and closer, we'll see different areas. If we think of this from a class perspective, this side is typically the investment side. So if you're taking a class in investments, you focus predominantly over here. You're looking at how investors invest, things like that. Generally speaking, over here is corporate finance. Corporate finance deals with how you raise money, what types of piece of paper you want to sell, as well as whether or not we should pay dividends. Should we do stock buybacks? Things like that. Should we reinvest at the firm? If we're doing a capital budgeting decision, this is, should we invest in an asset? Capital structure decision, what type of asset should we sell? In the middle is financial institutions and markets. money in banking, classes like that. Now, that said, and I think this is very important, you can't do just one. You almost, I've used the term holistic finance. Holistic finance is the idea that you are looking at all areas at one point. So for instance, let's suppose you are a corporate CFO. You need to know not only corporate finance, but you also need to know investments. And the reason being, you are selling a piece of paper to investors. You have to know what they're looking at. You have to get into the mind of the investors. Similarly, if you're an investor, you have to know what the corporations are selling you. You also have to know what institutions are available to help you. So again, this is our whole financial system. That's all we have. We will look at it throughout your entire financial career. But you really do specialize in certain areas, but you need to know the whole. Holistic finance is important.